China. Let's look at China right now. So we are bullish on the world. We are bullish for the US. How about the China market? What do I think about China? Well, China has a very strong macro picture, okay? China's GDP is projected to grow double the US. It's projected to grow at 7.5 to 8% this year because of early containment of the virus through strict action. Because as you know, in China, like I said, they are very, very strict. You have to wear your mask. You have to stay at home. You don't go out. You go for testing. You get vaccination. If not, you go to jail. Okay. And one thing about Chinese people is they are very compliant. Okay, I follow, right? But in the Western world, they tend to value freedom more than health and security, right? In the West, it's like, would you please wear a mask? No! I'm not going to wear a mask. You take away my freedom. It's land of the free, home of the brave. I'm brave. I don't need no mask. Yeah, and now it's out of control, right? Yeah, but because China was really strict, and so is Singapore. Singapore's really strict. Like in Singapore, if you go outside, you go to jail, man. You go to prison. I just read yesterday, a nurse in Singapore, she went out of her home during the lockdown, and now she's serving 6 weeks in prison. Yeah, so you don't screw around with Asian government. They will lock you up. All right. Okay. So because of that, Singapore, we have no more lockdowns. We are free to go anywhere we want. China is more or less contained the virus, although there's now a bit of a breakout, but I think they're going to contain it again. And one of the few countries to avoid a recession in 2020, right? That's number one. Number two, now with Biden in charge, we expect he will still be tough on China, obviously, but we think there'll be less volatility with the trade war, okay? And in fact, COVID-19 may help China overtake the US and the West as the world's largest economy because they were able to contain the virus a lot faster than the Western world. China's share of the global economy was only 3% in the year 2000. Today, 17% of global GDP is from China. That's right. Pretty scary, right? And China is projected to become a high-income economy by 2023. Okay, so if you take a look at this projection from this UK-based Center for Economics and Business Research, it's projected by 2027, China will officially become the world's biggest economy. It is inevitable, like Skynet in the Terminator. It is inevitable. And the other interesting thing is that post-pandemic, China is expected to contribute 26% of global growth. 26% of global growth, more than all the other economies combined together. All right, so you can't ignore China, man. And I know that the US, of course, they're doing all they can to fend off this economic threat, right? With sanctions and with tariffs and all those things. And yeah, I don't blame them, right? Because, if a rival is coming out, you got to keep him back. But like I said, it's like Skynet in the Terminator, right? It's inevitable. It will happen eventually, right? So to me, I invest in both markets. I invest both in the US and in China. Why? Because whoever wins, I win. I've got no love for either governments, all right? So I just love to make money, that's it. Whoever makes me money, I make money. Okay, so China's growth is supported right now by a rebound in consumption, sharp recoveries in tourism and leisure, and investment rebounds because of the lower US-China rhetoric in the trade war. Okay, and China has transformed from just a factory that copies people to a leading innovator. Right now, Chinese tech companies like Baidu, like Tencent, like Alibaba, are now leading in global innovation, in artificial intelligence, in fintech, in mobile payments, in health technology. Those of you would have heard me say this before. Right now, Facebook is trying to monetize WhatsApp, which is good for their business. Facebook is now going to digital payments through Libra, right? But what Facebook is doing now is what Tencent in China has already done many years ago. So China, in many ways, is way ahead of the West in terms of financial technology. Okay, so very bullish on China as well. Now, if you look at the charts, now I must warn you that the Shanghai stock market is really volatile. It's like a crazy roller coaster. All right. What I love about the US market is the US market is relatively tame. The trends are very smooth in the US market, like that. But China, the Shanghai market looks like that. Okay, so you got to be prepared. High volatility, right? So let me show you the charts right now. Okay, so this is the Shanghai index. Now, if you take a look at the long-term charts, let me show you the long-term chart. This is the long-term chart of China, Shanghai. Look at that, right? Wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down, wave up. So right now, we are on a wave up, right? Could still go a lot higher, right? And you can see a very strong support here. Can you see a strong support here? Strong support, strong support, strong support. Doing, doing, yeah. So if you have been watching my videos, I hope so. If you have been in my community, you would have been buying right there when it hit the support and now making a lot of money, right? So how do you buy the China index? You can buy the ETF. So the ETF would be ASHR. This is an ETF that tracks the Shanghai index. Okay. And you can also buy the GXC ETF. And this tracks the Shanghai, Shenzhen, Shenzhen, and the Hang Seng Hong Kong markets. Okay. So this is in my portfolio, as my community would know, right? You can see where's my GXC. GXC there, right? You can see GXC making like, yeah. So I got in about $95. Now it's about $146, right? ASHR, this is the one, ASHR, this is the China ETF. Got in at $27. Now it's at $42, right? So these are the ETFs that I'm holding. Okay, so this is a long-term chart. Now, like I said, if you look at the short-term chart, it looks really volatile. Let me show you the weekly, the daily candles, the weekly candles. Look at that. My God, right? Oh, trend! Oh, trend! Ah! You're going to be prepared for that volatility, right? Now, if you look at the daily candles, short-term, there we are. You can see there's a downtrend here. Boom, reverse to an uptrend. There was a strong resistance there. Resistance, 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 resistance. And I said it was going to break out last week. And sure enough, it broke out, starting a new uptrend. Okay. Is China expensive or cheap? Well, let's take a look at the PE ratio. So this is the PE ratio of the Shanghai index for the last 24 years. So you can see that in the last 24 years, the average PE ratio is 38 times. So anything above that, expensive. Anything below that is undervalued. So currently, where are we? Currently, as of yesterday, the PE ratio of Shanghai index is 33.36. So what does it tell you? China is cheaper than the US. China offers a better value than the US markets. Okay, but again, having said that, there is a lot of volatility. So in my portfolio, 65% of my investments are still in the US, 35% are in China. And I'm looking to maintain that allocation. Okay, let's move on. All right, so my overview strategy for China. I'm maintaining a 35% allocation to China stocks versus US stocks. Chinese equities are my favorite among emerging markets with strong growth potential at reasonable valuations. Now, some people are afraid of the trade war and the US may sanction China because of whatever. But let me tell you something interesting. Among China's listed companies, like Alibaba, like Tencent, like JD.com, only 2% of their sales comes from the US. And 86% of the company's sales comes from the domestic China market, because it's 1.6 billion Chinese people. So basically, China can say, screw the rest of the world, I don't need you, and they'll be fine. They don't need America. China doesn't need America. China doesn't need the rest of the world. They can survive on their own. Okay? So, I'm not too concerned about the trade war. All right? Now, having said that, for Chinese companies, I'm wary about buying small companies. I'm wary about buying speculative companies. I only buy the biggest companies in the market. And I only focus on companies in China that have secular growth drivers. That means they've got exposure to 5G, to cloud computing, to fintech, to health technologies, and to AI. And I only buy China companies with low debt. So I avoid Chinese banks. I avoid Chinese real estate companies. I only buy Chinese tech companies that meet my criteria. Again, consistent cash flow, low debt, and a sustainable competitive advantage. All right. And recently, as you know, there was an opportunity to buy more Alibaba and Tencent shares at a discount. And I hope you watched my video on YouTube, because Jack Ma, aka the Martian, he insulted Winnie the Pooh and got slapped on the face. And that caused Alibaba to drop about 20-30%. And so I was buying like crazy. Thank you, President Xi, for making Adam rich. I love you too. Yeah. Okay.